Good morning, options traders. Steve Ganz here in the Compare and Contrast series. And if you didn't see the start of this, go back to the prior video. I'll put the link in the description below to where you can see what the concept was here on this Tesla earnings trade. So the goal here was to put on two different trades over earnings, one being a calendar spread, the other being a butterfly spread. Now, Tesla announced earnings last night. Price shot up dramatically from 144 to 162 right now. So if we look at our P&L diagrams, that's going to be way out here, which is going to be a loss on both of these trades. But keep in mind, the goal here wasn't necessarily to produce a winning trade in this specific case. These are paper trades done for educational purposes, and the goal is to compare and contrast how two different trades might react in a situation like this, in this case where there was a huge blowout in earnings. Couple quick things to point out. First of all, at earnings, volatility is very high before earnings. You'll see this date is April 26th for this butterfly. That's this Friday, so 2 days from now. So as soon as the earnings get announced, this volatility is going to drop significantly, and that's going to impact our T0 line as soon as the market opens. The volatility is largely left now after the earnings announcement last night. The market just hasn't reflected that yet because, of course, the options market doesn't open for another 2 minutes. And it'll take a couple minutes once it opens for all this to happen as well. But at 160, we're going to be near, or 162, we're going to be near a total loss on this. Now, over here, you'll notice that the volatility is different. Why is the volatility different? Because on the calendar, we actually have the volatility spread over two different strikes. We have the April 26th strike, which will have the same volatility as these here. And then we have this April 3rd strike, which is the next Friday. That's going to have a lower volatility associated with it because it is a week further out. The further out you go in options, particularly around a binary event like earnings, the volatility is lower on those. So these two strikes are going to have different volatilities. If I look at this May 3rd one, we can see here the volatility on this is 87. If we look at the one that expires this Friday, that volatility is 148. Okay, bell just rang, market just opened. It's going to take a minute or two for these two to adjust, but let's just see what happens here. There we go. Okay, so the adjustment happened, and we can see that on our calendar here, one of the things that was hard to tell is how much this tent shrunk up, because our break even originally was all the way out here at around the 162 range, somewhere in that general vicinity. And right at the open, I'm going to change the range here that we're looking at so that we can see that. That tent shrunk up significantly. That's one of the unique and odd features of calendars, is that the calendar tent is not a static or a fixed tent. The butterfly tent will remain its same width. Those break-evens are going to remain the same pretty much, the break-evens at expiration will remain the same pretty much no matter what. In the case of a calendar, this entire tent is going to shrink and expand. Now, our overall risk of loss is not going to change. That will remain the same, and that is what we paid to get into this trade, which is $120. And I'll say that with one caveat. That caveat is, on Friday, this strike is going to expire. You do not want to leave this one open then, because you would have one-sided risk at that point. So let me just show you what I mean by that. So if I come in here and I just exclude that particular option, we can see here my loss can be significantly higher. Now, it's not an unlimited loss in this case because this is a long put, but you can see that it's way, way higher than the $120. So that one caveat is that when this front period option expires in a calendar this Friday, I have to make sure that I'm closing this back one at the same time. Or there are other techniques you can use. You can, turn this into a into a vertical spread by going out and maybe selling 150 or something put on next Friday's expiration, essentially turning this into a vertical spread. There are other things you can do, but just know that the P&L here is calculated off of the fact, the max loss P&L is calculated off of the fact that when this one expires, you will also be closed out of this one. So that's the game plan here, was to show you specifically how these two react after the volatility drops out. And you can see here our volatility dropped from whatever it was, 160, 170, or somewhere in there, down to about 109. Here, the volatility was less. I think it was 138, somewhere in there. It's dropped down to 80. And this will continue to drop as these trades work their way to expiration this Friday, the 26th. I'm just going to leave these set here. Again, these were not real money trades. These were paper trades and designed to specifically show you how they react in this environment. And we can see here that Tesla is in fact pulling back a little bit at this point. Now, if it does in fact continue to drop back here, maybe into this 154, 150 range, etc., these trades could potentially work their way back to profitability. So that's not my game plan here. That wasn't the purpose for the trades. It was simply to show you how these two compare and contrast around a binary event. So that's it for today. Thanks so much, everyone.